Okay. So in your notes, you want to write this down. There's three uncertainties that you have to embrace. You have to knowingly, willingly embrace three specific uncertainties in market and in speculation. Number one, black swan events. A black swan event is something that nobody can expect. No one can time it. It just comes out of nowhere. There's a time or season when it's probably likely, and we've been on a sustained timeline for that. We've been seeing all kinds of different black swan events over the last 3 years or so. And that's basically COVID related, um, war related, all kinds of economic upheaval. And we have one that's looming now with the central bank digital currencies. So that's going to absolutely impact the markets and currency trading. So that's an uncertainty. Okay, that black swan event, that thing that pops out of nowhere that can cause the market to go crashing down or raging higher, depending upon what the driver is or what the event is. The second is we do not, no one knows, I don't know, and you're never going to learn where the new week Sunday price opens. And you never know, for number three, where the gap opening price at 6 p.m. will be. So the new day opening gap and the new week opening gap and black swans, they are three uncertainties that you have to embrace. And the wonderful thing is, with the exception of the first one, the other two, we don't need to know what they are. But once we have them, it gives us insight, which means sitting on your hands, allowing the tape to give you the storyline. Let the price tell you it. Don't try to guess it. Don't try to forecast where these opening prices are going to be. Now, I'm going to teach how we can anticipate sometimes, not all the time, sometimes where the gap would move in our favor at either the new week opening gap or the new day opening gap. So those lessons are forthcoming as we go deeper into March content. If we look at the review on the 12th of 2023, the two scenarios I would have preferred to see, neither of which gave me an outline to work with when we started trading on Sunday. We had a higher gap opening, not by much, and it traded back down into the range that was formed in the last hour or so of trading on Friday, previous Friday, not yesterday. But I mentioned that if we were gap higher, that would send my mindset to looking for it to trade higher into imbalances and maybe press into a higher time frame order flow. But I preferred gun to my head, which is always what I do, because I know some of you will invariably listen to what I'm saying and say, he's calling both sides. No, I will go both sides when I have no idea where it's going to go next. But then I co-sign by saying, but if I had a gun to my head, this is what I say. So I'm always giving you my opinion, but my opinion is always laced and provided with a disclaimer stating that we're only talking about what I believe may happen, not that I have hard evidence to prove that the bias is going to be this or that. So that way you can see that because of that uncertainty, this is the reason why I don't speculate as much on Sundays anymore. I don't do a lot of the over the weekend holding of trades anymore because there's too much gap risk. What is gap risk? What we were talking about so far in this presentation. You don't know where we're going to open on Sunday. I don't know. No one knows. It could be an enormous gap difference between Friday's closing price, higher or lower. You have absolutely no way of knowing what that's going to be. And you don't know if it's going to gap severely away from Friday's closing price and then still scream in the direction of the gap opening price. You don't know that. I don't know that. So we have to always see what those opening prices are going to do. Once they give it, sit on your hands and wait. What are we looking for? Continuation or failure and reject, and return back into the range that was created by the gap opening price and the previous session closing price. Having these uncertainties in price, many times that uncertainty and fear and anxiety about not knowing what's going to happen at those times leaks into other times where the market is a little bit more predictable. Now, I say that loosely because I don't want to convey the idea that you're going to know. You're going to know where price is going to go. No, you're going to have a measured, statistically weighed out, things have been more times like this than not type of scenario, which is why I say the first lesson I teach you as a student is to understand where the market's likely to go to next. What's the potential draw on liquidity? Is it above market price now, or is it below market price? Notice that I don't ever say, and my lessons never state that it's absolutely, unequivocally, without a doubt, promised that it's going to go to that level above or below. It's just more likely to do that. Now, more likely is equivalent to you more likely than not arriving to your job safely and soundly in the manner you woke up and left your bed when you go to work. The same odds are that in the marketplace, but you don't see it that way because you're placing what? You're placing the emphasis of a monetary reward or loss on the transition between you entering your car and getting to work. No, you don't do that, but you do the same thing with trading, though, as you should. You should have the measure of respect, but you don't think about the monetary loss of potentially driving over a nail and getting a flat tire, do you? Or curbing a tire, busting it, getting into an accident because you were looking at ICT tweets and scrolling through a video to hear a certain part that you didn't get to, and something happens that causes you to crash. Those things, those uncertainties, are always going to be in the marketplace. But what I'm teaching you to do with the tape reading is allowing you to see the things that are going to be more pertinent to you as a trader. What makes you tick as a trader? We all are studying price delivery. We're all understanding that these concepts have an influence over what price is going to do. But you don't know which one you're going to use for your setup. Some of you are at stages where you can see them perfectly in hindsight when I show them to you, and it makes perfect sense. And you can't see it real time. That's normal. Some of you can't even understand the logic with me showing it to you in hindsight because you're absolutely brand new. And that's normal too. Some of you are now discovering how comfortable it's becoming for you to see real-time 1-minute candles painting and the logic behind where price is going to gravitate towards, that draw or inefficiency that's going to pull price higher or lower. It's not so random anymore. And that is now normal for you. You're all at different stages of your development. And the measure of the tape is going to provide you a different measurement based on the time you've been spending with me in the concepts I teach. But understanding there's 3 primary uncertainties that you cannot absolutely know. And you will never know. And I promise you, I have no secret weapon, no algorithm twist, nothing in Enigma tells me where the opening price is going to be. Nothing. I have absolutely no. I have to submit myself to the will of the marketplace. And once it does whatever it's going to do at these times, then I measure what it is I'm looking for. What is it that I'm looking for? I've shown you this week. We traded down to certain levels after a gap lower. I want to see it run buy side. It does. I want to see it run sell side. It does. And those narratives during those live streams that I'm telling you, because we're not lost in price. We're not lost in price. We're not lost in the candlestick jungle. We're waiting for a clear path to a destination that we have already set out for, looking in a direction. This is where we're likely to go, but we have to wait. We have to wait for the market to tell us, okay, now it's done its damage in tricking other traders into thinking it's going to go the opposite direction to that. That's manipulation. That's the thing that we like to wait for after these gaps, after the session open at 9:30, at the 8:30 news embargo when it lifts. We're waiting for those little tricks, those little unfortunate events that the lesser informed speculators are not aware of. And they fall victim because they're using concepts they've learned in books based on breakout strategies. And then, or looking for confirmation after a move has began, and they chase price. So in my live sessions, I'm many times drawing on the ideas that you as a retail trader or someone that is not in our community that trades purely on retail logic, how they're going to perceive price at that moment. And the times I'm saying that, I want you to write down your notes. When I say those things, when I'm referring to a retail trader's mindset or a concept that they may see right now, or they're shorting here, or they're bullish here, or if I'm referencing where their stops would be at that moment, and I failed to mention this prior to this now, but I've mentioned it in passing in lectures. But when I'm doing a live session and I'm calling real-time candlesticks and where the price is going to go and what it shouldn't do, when I mention or reference retail logic or retail stops, at that moment, at that very moment, I want you to think about that wrestling match, that arm wrestling match, that war between the real market maker versus the people that trade on patterns for pattern's sake. The emphasis of believing that price is going to go up, the hopes and fears, the outcomes of billions of dollars. Where's it more likely to follow the logic of some kind of harmonic animal pattern, some kind of Fibonacci ratio, Gartley retracement type thing, a butterfly, crab, shark, all those things? Billions of dollars are going to be weighed in the balances on those gimmicks? Or is it based on real order flow and where existing orders are above or below the marketplace? Clearly, clearly, it's the latter. Large institutions, large banks are not trading on harmonic animal themed named patterns. They're not doing that, folks. They're never teaching you what they're really doing. You hear people say, learn how to trade like the banks. They're not teaching you how banks trade. I'm teaching you how banks trade. The logic is proven. It's to the tick precision. It's predictable. It's not something that's ambiguous. We're looking for very specific things to repeat at a specific time of day. And that when that logic shows itself at the same time that some retail logic theory concept pattern, and I'm just going to say pattern because predominantly, and this is my experience when I was learning as a new trader back in 1992, in the first 5 or 6 years of it, most of what I was looking for was a pattern with an indicator to tell me something. When nobody was telling me to look at the things I'm teaching you, which is time and price. I was more concerned about if my Fibonacci was set to the right settings. Was I really in an oversold condition? Because not every one of my indicators would agree that we're oversold yet. I would use this person's book just because it just came out. I figured, okay, this is the person that knows something new now because he produced a new book. And it was the same stuff. It was the same things all the time. So when we look at price, we're looking for specific times of the day to produce a specific expectation that we hold over the price. We only are interested if price can go to this level above where we are right now. That's buy side. That means we're bullish. We are not trading yet. We're anticipating the market to give us some kind of tipping of its hand. We're waiting for some kind of algorithmic display in price action that would qualify for now. This is the time when we want to engage. Right now, our attention at that point is interested in seeing it do certain things at a specific time. But once those things occur, what is that? A shift in market structure, a run on stops. That's it. Two things. That's it. That's it. It's either going to run stops, then we're going to wait for a rejection of that. What happens after that? A breaker. But no. If it runs stops, we're looking for a breaker. But what happens if it hasn't gone down below what would be a breaker yet? We're considering any imbalance prior to that. Oh, well, that seems pretty easy. Yes, what I've been saying all along. But you're trying to bring in commitment of traders and ICT stingers and catapults and whiplash patterns and everything else that I've ever taught. You're trying to bring everything to it. Think about it. When you get invited to a party, you know your favorite outfits, right? You know what those favorite outfits are, especially the ladies listening. You know that's the one you look like the bomb in. Now, when you get invited to the party, you're scrambling initially. Do I really want to wear this? Do I want to wear this? Do you bring all 5 or 6 of your favorite outfits that you look the bomb in? Of course not. Of course not. You settle in on one. And that's exactly what you're doing as a trader. You're going to settle in on that one pattern, concept, PD array, multiplier, that thing that you're going to use as a trader. That's where you're going to be the bomb in. Now, you look good in all the other outfits, but you have a special affinity for this particular one. And that's the one you want to represent yourself in. Well, as a trader, it's no different. I'm giving you the invitation every day in a live session to come to the party. But you're going to pick out what particular PD array resonates with you. It matters not what anybody else thinks about what you should trade or use as a catalyst for getting into a trade. It matters not what my opinion of my favorite ones are. Many of you ask a lot of times, hey, look, you teach a lot of things, but what's your favorite setup? Because it's going to be easier for me to just cut through all the chaff and go right to what ICT's favorite is. They're all my favorite. They're all my favorite based on whatever the market's doing. I'm plug and play. I've authored these things, so I can pick and choose whatever one I want to use. I can use all of them if I want to, which is what you see me doing when I'm doing pyramid entries. I'm literally using every single one of them that's available at that time during that market move. But not every single PD array is going to exist in every single price run, which is the benefit of understanding them holistically, not just individually. Because I could literally write a book 300-400 pages long and not even scratch the surface on one PD array at a time. That's how deep this can be. But it need not be that complicated. It just simply needs to be, which one do you like the most? Which one makes the most sense to you right now? And bloom where you're planted. Don't think that that's the best you can be or where you're ever going to be as a trader. It just means that gives you the first initial foundation to start your growth from, which is really critical as a developing student because it's too easy to springboard and bounce around to different teachers, concepts, approaches, all kinds of things. And you'll never learn. You'll never learn that way. You'll be introduced to new things. like a drug. Here, try this one. Here, now try this one. Here, try this one. And you're never really clear headed and focused on the thing that you're supposed to be looking for right now, which is one specific model that you can start with and build an understanding from and grow as a trader.